Welcome to On the Record, a webinar series from Vinyl Equity. Today's topic is the future of the capital markets. Rob Scoder, founder and CEO of Vinyl Equity, has a conversation with Brian Steele, Managing Director and President Clearing and Security Services at DTCC. We hope you enjoy this conversation, and Rob, now over to you.
Hi, everybody. It's been a while. We had July and August off, but we've got a great guest here today in Brian Steele. So welcome to On the Record. My name's Rob Scoder, if you haven't joined us. The CEO and co-founder of Vinyl Equity, which is the first novel SEC-registered transfer agent platform catering to public companies in probably about 30 years. So today we're talking about the future of our capital markets, which is something that we feel very passionately about, and we're thrilled to have Brian here. Brian is the president of Clearing and Security Services for the DTCC. He's a longtime financial services exec who joined the DTCC in late 2023. Brian, welcome to On the Record.
Thank you, Rob. Yeah, thank you. Thank you for having me. Excited to be here.
I've been looking forward to this one for a long time. I'd love to have you start by just telling us a little bit about your background and what led you to the DTCC, and then we can get into the meat of the discussion.
Perfect. Yeah, happy to. So I've been at the DTCC for the last 2 years, and prior to that, prior to joining DTCC, I was at Goldman Sachs for nearly 20 years in a myriad of roles, and sort of started my career in a series of operational roles, and then sort of transitioned later in my career to really much more focused on market structure, regulatory change, client experience. So really over the overwhelming majority of my career at Goldman, I was interfacing with folks at the DTCC, and so it was when this opportunity came about, it was in some ways it almost felt natural that there was sort of a next step in my career to join such a firm that's at the center of markets in so many different ways. And so if you're sort of a market structure person, right, and being at a firm like this where you're really in many ways shaping market structure, as well as obviously the critical role in what we will ultimately do to serve markets in the context of market structure today. It was a natural transition. And so I joined the firm. I'm responsible for, as you said, our kind of clearing and security services businesses. And so, that's, I take kind of great pride in terms of, the role that I, play in servicing those businesses today for the market, and obviously kind of where we're going as a firm.
So you talked a little bit about market infrastructure and the importance of it, and how the DTCC plays this central role in market infrastructure.
Yes.
But can you actually talk a little bit about what the DTCC is? Because I suspect that there are a lot of people that don't actually understand the scope and breadth of and function that the DTCC performs.
No, you're right. You're right. It's one of these. You say it's critical market infrastructure, and try explaining it to my parents or my wife or something. It's not. I think it gets sort of lost in interpretation in so many different ways. And so, the DTCC is it was founded in the early 70s, based on largely based on the paper crisis that was existing. Right, equities was expanding and pretty rapidly, pretty significantly. And, sort of the bond and stock certificates that were kind of trapped in broker dealers' drawers, right? There was sort of a thinking that, we should create an entity that, largely, stood up by the banks that would ultimately centralize and automate and over time, obviously, in some ways dematerialize those certificates, create scale and efficiency for markets, right, in such a manner that markets can operate, much more efficiently. And so that was the premise of why the company was stood up as I said, in the early 70s. Now, DTCC is sort of a compilation of a number of different products and services that over time were sort of independent legal entities that operated in some cases even outside of DTCC, that were through acquisition. that we become the company that we are today. And so, I talked a little bit about obviously the role that we play at DTC, which is the depository that the firm runs, and that is the central securities depository for securities in the United States, right? And so if you look at, well, how does that compare to others that sit outside of the world? Well, in Europe, as an example, there's multiple depositories that exist, that some of which are local to a particular country, some of which are international CSDs like a Euroclear or a Clearstream that cover the multitude of jurisdictions across Europe. In the United States, as it pertains to securities, we are the single depository, and so that is our depository. We also run two clearinghouses, right, that also have materialized over time, and so we are the only clearinghouse for cash equities in the United States. We have a legal entity that we call the National Securities Clearing Corp that sort of stood up as well in sort of the mid 70s and clears assets. And what's the value of a clearinghouse? Well, clearinghouse obviously reduces the risk of the intermediaries, the credit risk that you're exposed to of transacting between two different parties, where the clearinghouse now steps in the middle of that transaction and reduces significantly the credit risk of those two different parties, but equally takes through the process of netting, provides an incredible amount of capital efficiency to the ecosystem. Hundreds of billions reduced, to, or really in this case, trillions of dollars of transactions reduced to sub 100 billion of cash that ultimately needs to get exchanged between two parties on a given basis. And so that is the equities clearinghouse. We equally run we are prominent in the treasury market and in the mortgage-backed securities market in terms of our role clearing those assets. There's a pretty significant regulatory change that's we're sort of in the middle of as it relates to mandatory clearing coming to the treasury market. And so we're playing what we feel like is a pretty important role in helping the market move, not only clearing, call it 60 to 80% of the asset, depending on how you value it today of the treasuries that are in the market today, but equally covering the delta of those that will ultimately need to, through mandatory clearing, the rule that the rule that the SEC put forth, that helping the market move into clearing in a capital cost efficient way, right? And that's ultimately the work we're doing. And I think that's kind of, those are the services that are sort of what you know of DTCC, right? We run two clearinghouses. We have a deposit. It's interestingly enough, we do other things as well, right? We have a wealth business that, and in the late 70s, stood up a platform called FundServe that handles servicing for mutual funds. It handles over 50% of the mutual funds that go through the retirement plans, 401ks in the United States. And that even to this day is not a very well-known set of product and services that we offer at DTCC. And we also run a regulatory reporting business. We have 85 to 90% of the market as it relates to being a trade repository, helping clients in an efficient way report their transactions to meet the needs of regulatory reporting jurisdictions around the world. And if you think, well, what these seem like sort of a disparate set of services that fall under a DTCC banner. Well, the ethos of the firm is really serving the needs of the market and helping create utility and cost efficiency and scale, really aligned to inefficiencies in the market, but equally regulatory change. And so many of the things that, the services, the products, the businesses that we've stood up at this firm have been a function of how the market has evolved and how we've helped the market evolve with it in an efficient way.
I think there's maybe some nuance here. Can you talk a little bit about who owns the DTCC so that, I think one of the things that's really interesting is how you all have to navigate or thread the needle between the regulatory climate and the business climate. Some of that is owed to the position that you have within our capital markets. But I think, your ownership structure is unique as a corporation. You talk about it a little bit and shed some light into it, because I think that it ultimately has implications on how you all innovate and how you all drive change for our capital markets broadly.
Yeah.
So I'd love to get some insight into that.
No, Rob, it's such a great question, because I think as much as those, I still get this question today, right? By, even by our existing clients, sort of what's the ownership structure of DTCC and how are you organized and et cetera. We are, in simple terms, we're user owned, user governed. And so what does that mean? Well, we're owned by our members. And so to the extent our members use the services, that's to the ownership percentage by which they are an owner of DTCC. And so, what does that mean? Well, it's different than how you think about other market structure firms, either public or private firms that exist that are serving the needs of the industry, depositories, clearinghouses, exchanges, other fintech providers that are providing different services around netting or aggregation. The fact that we're owned by our members, right? We're serving the needs of the market, right? We're serving the needs of what's best for the market, not what's best for the firm's results, or best for P&L, or best for revenue. And so I think that in many ways, we have such a trusted relationship with our regulators that I think that puts us in a unique position, because we don't stand to benefit from one segment of the market doing better than another, right? Which I think is very different than many of the other kind of client segments or market segments that exist in our industry. And that allows us to be sort of a trusted party amongst many, right? In terms of, so we have a board structure that sort of helps to be part of the governance structure that governs the firm, and that board structure is made up of representation from many of our member firms, and it does have also independent board advisors as well. And so I think about our constituency group as, we have our board, we have our regulatory, we have our regulators, and then we have our thousands of clients. Because in so many ways, if you're either a direct or an indirect client of the firm, if you're transacting in the assets that largely are serviced by DTCC, which is the overwhelming majority is securities. But I mentioned that we have sort of a trade repository business that equally covers the obligations of the derivatives market. So it's not just securities mostly, but also kind of derivatives as well.
I think one of the things you've just talked about is your membership base is also your ownership base. Those members, and if we were to just qualify who the members are, brokerage firms, clearinghouses, right?
Yes. Yes. So yes, you're exactly right. So yeah. That's right. So banks, broker-dealers, custodians, typically our members will be those that transact with, asset managers, those that will have that are a participant or a member of the clearinghouse or the depository. And so there's some incentives there to have very broad representation so that you can find a balanced approach to market infrastructure and technology. And one of the things that you and I have talked a lot about is what direction we're headed, right? Yeah. And so how does the DTCC then evaluate innovation like accelerated settlement, tokenized assets? There's just a couple of the buzzwords we've heard over the last few years. And how does it balance representing member interests along the way? Can you talk a little bit about that? It's a great question. I think because we have such a broad membership base, we have to be thoughtful as to how we collect feedback from our clients that help inform where we ultimately make investments and where we focus our efforts as a firm, right? And I think we do that through a couple of different ways. I mentioned the governance structure around our board, but equally, if you expand out, we have a myriad of advisory councils that we've set up as really what you can think about those as our client advisory boards, right? That's a mechanism for clients to engage with DTCC across every one of our businesses and really help influence what DTCC should be focused on, but equally help us inform where we might be missing something, right? How should we think about tokenization or accelerated settlement or getting involved in new opportunities like private markets, or the end number of possibilities, much less even just expanding and enhancing the existing set of services that we offer today. So, it's just because you mentioned accelerated settlement, and I'll talk a little bit. What was interesting is what may not be well known. You sort of went back to the chronology of how we got to T+1 in the equities market. DTCC, to its credit, and frankly, I wasn't here, so I'm going to take zero credit for that. But DTCC, to its credit, did publish a white paper before the sort of the meme stock events that caught the eye of the SEC, and sort of really sort of put a little bit more focus on reducing the settlement cycle as a means of putting more capital into the ecosystem and reducing the time between execution and settlement. And so that it was just an indication that there was some foresight that the market potentially could move in this direction or should move in this direction. It would be good for markets to do so well before that was sort of a regulatory kind of mandate to do so as a function of moving the market in that direction. And so, and then as it started to become much more of the direction of travel, working with our regulators, it really opened the aperture to how do we make sure that we get the right level of client feedback, understand the impacts of the market, and then obviously what you've seen last year in terms of successful delivery of the market moving successfully with a accelerated settlement cycle.
How long does it take you all collectively, and I recognize some of this is outside of the scope of your time at the DTCC, to aggregate that feedback for something as significant as the move to T+1? I mean, that is in many ways, it is something that has an impact on the global economy. I mean, we've seen other markets now trying to catch up if they haven't gotten to T+1 already. Can you talk about the time scale of innovation and the work that you're doing and the way that you incorporate some of that feedback?
It's a great question. So I'd say a couple things. One of which is the cornerstone of this firm is focused on risk management and resiliency, right? The role that we play in markets is where there's an expectation that we're meant to be up when markets are up. And it'll be interesting as we start to, maybe we'll get into this. We'll talk about 24/7 or 24/5. And what does that really mean? Well, I guess we're up continuously. But for now, there's certain operating hours, and we're expected to be up when the market is up, which we take that role incredibly seriously. Now, innovation obviously takes a level of kind of thoughtful projection of where the markets are going, what our customer needs, where can we play a significant role.
I think what you're hinting at is that the DTCC is not a move fast and break things kind of business, as Mark Zuckerberg might have.
As much as I'd like to say that we want to fail fast, it's sort of like failure is not an option, right? So, but I will say that sort of methodically working through at a much faster clip, we're being able to work through opportunities to create new scale, create new market infrastructure, evolve our existing product mix is absolutely the aspiration of the firm. And obviously technology is helping us do that. That's some behavioral, some cultural, but equally technology is helping us do that. But the significance of a move like moving the equities market from T+2 to T+1, there's so many constituent parts that are impacted. This isn't a DTCC decision, right? This is impacting, as you just said, the global markets in so many ways, and all those that interact with the securities market in the United States. And so we were thoughtful about the client outreach, client impact analysis, et cetera, that went into that type of a change. And then, the right phased and sequenced implementation period that allows for testing and all the change controls that you'd want in place, such that when we did make a move, and in this case it was actually a big bang move, it was a weekend, we went live on that that there's no sort of turning back, right? We're all going, and so we're the frictionless move is only as good as the weakest link, as we all can appreciate, right? And so we take our role not only as, well, did we make all the system changes and we tested everything? No, did everybody do that? And I can't tell you how many conversations we had with our regulators leading up to that event, where equally they saw that as our role, which is, your role as a steward of markets is to make sure that you're fostering everyone towards that goal line.
And that's such a massive scope. I mean, it's hard for me to imagine what the report cards looked like in getting things ready, right? I mean, you have to accept that there are always going to be some parties that fail, but the exposure has to be small enough that it's not going to be so significant. And I think one of the things we spend a lot of time thinking about is that the infrastructure stack is all these disparate parts that are represented in a lot of ways by siloed technology. And in many cases, different members of the infrastructure stack are sort of synthetically representing the reality of the world based on the data that comes to them. Many cases, it's represented on a delay because they're batch systems. There are, things that are systems that update twice a day as opposed to in real time. And finding a way to balance different people's or different entities' technological aptitude, right, or solutions is an incredibly complicated task for you all. And I imagine, it's almost unknowable right before a big event like that. And so no matter how certain you are that you've checked all crossed the T's and dotted the I's, you're still sort of going, all right, we're going to pull the ripcord tonight, and Monday lights are going to come on and we don't know what's going to happen. Obviously, I say that's an exaggeration, but can you talk a little bit about that, maybe from a personal perspective, how you think?
Yeah, there was a lot of soul searching and prayers that went into, I think that, you're 100% right. There's only so much we can do, right? Getting sort of to that last mile, which is, we had 26 different testing intervals. We allowed the flexibility for clients to test their own test trades, as well as we had very programmatic different types of transactions that they could test. We had positive affirmation from every single member who interacts with our products and services to say that they have tested, they feel comfortable, they're ready to go live, etc. But you're right. There's operational and technological issues that ultimately, could go wrong. That would completely, in some cases, completely disrupt the system and completely disrupt the move. Luckily, that didn't happen. I will say, I don't know how well known this is, but we did have a small hiccup on the night that we did go live, and there was a small technology issue, and I think because of the structure that we stood up as an industry, we were able to do a couple things. One of which was communicate quickly out to the industry and get feedback on direction of travel as to what steps we should take. Not simply the DTCC says this and we're going to move in that direction. Everyone has to acquiesce, right? We realize the ramifications of the decisions that we make. But more importantly, when we did make that decision, it was such a reinforcement mechanism for us that everyone had made investments, or most of the ecosystem had made investments in upgrading their technology, instituting automation in their business processes, that they were able to cope incredibly quickly. It wasn't something that dragged into the next business day. It wasn't something that dragged into the next open, and that was such a reinforcing point for us that. Despite the fact that we've sort of reduced the kind of business hours to process a transaction after it's been executed from, I think it was 18 down to 6 business hours, we have made the right investments as an industry to be able to provide that similar, if not better, levels of resiliency than what previously existed in the T+2 structure.
I want to just take that and run with it a little bit. One of the things we talk about a lot at Vinyl is the notion that you can get a package delivered in a few hours by ordering it on Amazon, and yet, from a securities perspective, we're talking 24 hours for shares to settle, right?
Yes.
We've talked a lot, and we've frankly in the last 6 months seen a lot more in the press on the utilization of new technologies to even further expedite settlement timelines. And one of the things that frequently comes up is blockchain technology, the tokenization of securities, whether, over the last probably 5, 6, maybe 10 years, there's been a lot of innovation and tinkering done in the alternative space. We're now starting to see the dialogue shift to the public markets. I think NASDAQ recently announced a $50 million investment into Gemini and put forth a proposal on the tokenization of public equities. And you all are maybe the most central part of that proposal. Can you talk a little bit about the DTC's position on the technology, what implications it has for the broader market, and then what does adoption look like?
Yes. So I would say a couple things. One of which is, I think you're 100% right in that the technology itself has such an avenue of opportunity for creating levels of scale and automation and efficiency. And I think, you pointed out earlier, which is such a sort of an astute point, which today market structure is largely segregated by asset class, region or geography, and then sort of regulatory jurisdiction, right? And that's why we have siloed infrastructure that handles a security versus an FX transaction versus a physical commodity, but all the different segments of our industry are sort of cut along those verticals. And I think the technology itself, and the ability to be able to sort of establish what is effectively the golden source of truth, and all the actors in the ecosystem that need to know about that transaction is the Herculean effort as it pertains to how things operate today. And of course that causes operational friction and costs and et cetera in the ecosystem. And so we think pretty strongly that the use of distributed ledger technology, tokenization, will have a pretty profound impact on financial services going forward. And so we've done a couple things in terms of our digital asset strategy, right? We acquired a company called Securrency, a tokenization technology firm 2 years ago, and that brought both a technology which we think is differentiating and a human capital into our ecosystem. So people who understand the digital assets landscape, right? And if you think about what's the role of DTC, excuse me, it is, we are the record keeper for security transactions in the ecosystem. And so what better for us to think about how do we expand our services and enhance in so many different ways, but to use distributed ledger technology to be able to do that, right? And so we have made a concerted effort and investment thus far, and will continue to do so for the next many years, to create a tokenization platform that allows us to be able to tokenize what it amounts to the 100 trillion of assets that sit at DTC today. And for what purpose? Well, extending our record-keeping capabilities on chain, right, in such a manner that clients will be able to tokenize their assets that sit at DTC, and then use those assets at their disposal on various L1 networks that the firm will ultimately integrate with. And so, we take seriously our role in helping to integrate with various L1 networks, and our philosophy about being open access very seriously, right? We're not picking winners and losers. Our role is to facilitate levels of interoperability and to facilitate access to tokenized assets. And for clients to define what purpose they use them for, right? Is it for collateral optimization? Is it for a more attractive or commercial financing purpose? Could it facilitate 24/7 markets and instantaneous settlement? Absolutely. And so I think, for us, we want to be able to create the framework and the capabilities that allow the market to innovate on their digital assets journey. And so we're sort of in what I'd say is sort of the early innings of doing so, yet we have real capabilities that we will be delivering to the market in 2026 that will allow for tokenization to be a reality and allow for clients to use those tokenized assets in the ecosystem of their choosing, assuming it meets all the controls and regulatory sort of, parameters that we still have to hold ourselves to as a function of being an operator of markets.
So many ways that I want to take this conversation right now, and I don't know if we'll have time, but so we're in the early innings of adoption of distributed ledger blockchain technology, and I think we at Vinyl feel very similarly. One of the things that we've seen is our perspective is that you all will eventually set the standard owed to largely your role in the markets as a stabilizing force, among many other things, but the breadth and scale. We see historically private markets innovation probably lead public markets innovation by 5 to 10 years, and that's just a general statement. Interestingly enough, the blockchain implementation could be more relevant for public markets than private markets to some, and may actually solve some of those friction points or the lack of integration that we've talked about, or lack of interoperability that we've talked about earlier in this conversation. Can you talk about how you see the tokenization of the private markets relative to the public markets and where you all are focusing right now?
Yes.
At DTC.
Yes, it's a great question, and I think I'd say a couple of things. One of which is, in some ways, the private markets are growing and well outpacing the growth of public markets, right? I think that's a very well-known statistic. But I think the maturity of the infrastructure that supports private markets is incredibly immature as compared to the very mature public markets infrastructure that exists and creates scale. And that's one of the reasons why we're pretty significantly evaluating what our role could be in creating levels of infrastructure that supports private markets, similar to what we've done, as we just talked about before, for 50 years in public markets. But at the same point, because the infrastructure is immature, in some ways it allows for an easier on-ramp to deploy technologies that, like digital assets technologies, that create that level of infrastructure and allow us to scale for the future. I mean, moving Herculean task of moving kind of public markets, very mature infrastructure, very well-defined ecosystem partners, et cetera, very well-defined client segments to digital assets infrastructure is going to be much more of in my mind at least, a sequenced event, right? And so, we're creating the foundation of that sort of interoperability I talked about, creating standards, enabling the tokenization of our assets, but we're going to go where there's client demand. And so where we're here that there is demand, and you may have seen there's a press release that happened a few weeks ago, and we helped enable a repo transaction between two counterparties on a network called Canton over the weekend, that obviously wouldn't have otherwise been able to be facilitated if not the asset had been tokenized before. We're going to respond to client demand where there's real value and real use cases. Again, as long as it aligns with those standards that we think we can help operate for the market. So I think there's a lot of, the conversations I'm having with clients to this point in time, a lot of education. Where is the market? Where can we get involved? But also a little bit of the art of the possible. Like, how should I think about this in the future? Where could markets go? Could we be operating on a much more kind of pre-funded, atomically settled, real-time market, much like sort of how the crypto markets operate today, much more for sort of TradFi public markets in the future? I mean, potentially, I think probably more realistically, there's going to be, different settlement and clearing modalities that we'll start to enable in the future, right? And that's kind of like the crawl, walk, run type approach, where if clients find value in instantaneous settlement or atomic settlement at the point of execution, because they can do something else with that asset, and actually in some ways they're willing to pay a premium for that, because it may not be the same liquidity pool, they may not get the same price, but they're willing to pay a premium because they'll be able to achieve some multiple on using that asset in some other mechanism, some other commercial facility immediately thereafter, because they have the asset at their disposal as part of that atomic settlement. Well, we should provide choice in markets, right? We should provide choice that responds to client demand. And so I think that the market will continue to evolve in much more of an iterative way as it pertains to public markets. And it will be, as we get more thought leaders sort of wrapping their heads around the fact that the market is moving in this direction, and it's sort of in some ways inevitable, you'll start to see real sort of real creativity as to what we can do with this technology that provides real commercial value. And I think that's going to be the real accelerant for how we move the markets forward.
How do you balance that? And actually, one clarifying point I want to talk about. We talked about DTCC's members. You've talked about clients. In some ways, clients are members. Members are clients. Can you maybe enumerate that a bit for everybody?
Yes. So I've sort of used those terms interchangeably, but we have thousands of clients because we have a myriad of services that we offer. I talked about regulatory reporting, our wealth business. We run an institutional trade processing business that focuses on confirmation and allocation processing for securities products. And there are different client demographics that use those various services. And then members would be the members of our clearinghouse. Now, of course, there's some overlap between those different sort of clients and members, but the members would be members of our clearinghouse and members of our depository, right? That is and again, it goes back to what you'd asked before, those are typically, banks, broker dealers, custodians, prime brokers, that are members, transfer agents, et cetera, that are members of our various services.
Helpful. Thank you. I just want to make sure everybody.
No. Thank you for clarifying. Yes.
The last question I'm going to ask, because we're running out of time here. You've talked a lot about furthering business interests. There is, of course, the regulatory climate. There is, of course, the global nature of our markets. Blockchain solves for instant settlement. It opens up the market to, near real-time settlement. It opens up the market to 24/7 trading, which lends itself particularly well to global access, frankly, to U.S. assets and securities, right? How do you balance business interests and the pursuit of profitability, capitalism, what have you, with regulators who I think, most people would look at the regulatory climate and say, by and large, it moves a lot slower than the rate of change in technology. Obviously we've seen, I think, more attention dedicated to the modernization of our capital markets over the course of the last couple of years, but it's not always constant. And I'd love to understand your perspective on how you manage that.
Yeah, it's a great question, because much, if not the entirety of what we do at this firm is in partnership with our regulators.
And actually, maybe just to clarify, Brian, every time you guys want to make a major change, it has to go out for public comment through regulatory channels, right? So can we talk maybe about that?
Yeah, that's a good clarifying point, because we have businesses at the firm that fall under the SIFMU designation, right? Systemically important financial market utility. And that's our clearinghouses and our depository. And yes, you're right. We have a rule book that governs those particular entities. And when we make a change, it needs to go out. It needs to go through to our regulators and out for public comment. Yes, that's it. That's exactly. There's a process by which we orchestrate change that is done for purpose, right? It's done because we need to ensure there's right governance, but also done because we need to methodically make changes so that it doesn't upset this sort of ecosystem. And any significant change we make, we understand the full breadth of the scope of the impact of the change that we make. But equally, we have products at the firm that are not designated as a SIFMU, that don't have a rule book associated with them. And so those, will require, obviously, we still do it in partnership with our regulators, and we still ensure that they're aware and they're apprised of changes that we're making, but we're not held to the same sort of rule book public comment standards. Not indifferent to how a fintech firm would they wouldn't maybe engage the regulator on every product change. They sort of, we want to sort of aspire to continue to move at a pace of change that sort of meets the needs of the market and does so, still with thoughtful consideration for risk management. But I think, in some ways you say, well, does that slow DTCC down from innovation? Well, it kind of goes back to what I talked about before, which is our sort of ownership structure, not our focus on profitability and revenue and P&L. That's not a part of the firm, right? We're in so many ways, given that our basis of being a utility structure for the industry, creates the right incentives for us to orchestrate change. And so that gives us a really close, tight partnership with our regulators. And so when we do want to take on a new business, or we do think that we're going to serve the needs of a particular market that maybe is a foray, that's something that we haven't gone into before, we sort of do it in partnership with our regulators. It's in so many ways, I view that as an asset of the firm, because we have that relationship and we can have sort of a bit of an open dialogue on certain areas. And that actually helps us move at a pace that I think maybe is a bit more of an advantageous to a firm like ourselves.
So last question, where do you see some of these changes that we've talked about specific to expedited settlement times, the utility of blockchain? Yeah. Where do you see adoption and implementation over the next 2-5 years? What do the markets look like? What are the most significant changes we're going to see?
Yeah, it's a great question. I think we've talked a lot about digital assets, but I think AI is as much a disruptive factor because it doesn't require a network effect like a digital asset solution does, right? And I think firms can innovate, using AI at their disposal in terms of how they create levels of efficiency, but still equally levels of commerciality. How do they create new products, new services they can offer to the market? But if we talk about digital assets, I think that's going to be an incredible disruptive factor for the market in a good way, right? Transformational in a way where it's starting to solve for many of those inefficiencies that we had talked about, but equally unlocking commercial value. Because I think, as we all have seen over in the past, where there's organic change, it can't simply just be for cost reduction reasons, right? There's got to be a commercial element to really ring fencing the appropriate budget and resourcing that many firms across the ecosystem are going to have to put forward to be able to deliver on the change that we think is possible and ultimately is going to come. So I think it's a long way of saying we think that digital assets will have a pretty significant transformational change in the ecosystem. I think there's support in the government, there's support in our regulators, there's frankly, this is also there's around the world. This isn't a specific U.S. market focused effort that I think will have real transformation. We didn't focus on sort of the digital payment infrastructure to any great degree, but the support of stablecoins in the United States, I think will have a real material impact about being able to use stablecoins for purposes of replacement of cash running on a 24/7 cycle. There are some significant components of digital assets that I think will really transform where the market is 3 to 5 years from now.
Well, of course, and I know you're right, we haven't talked about this much, but we could probably have another conversation for another hour or so. But the settlement of cash and the settlement of securities go hand in hand in a lot of ways, right? And so if cash settlement is outpacing securities infrastructure, then we've got this disharmony we need to synchronize. So Brian, amazing conversation.
Thank you, Rob. I think it's been great.
Watching might have felt like we were just nerding out on some of this stuff, but I really appreciate you taking the time. I had a great time going through this, and I'm looking forward to looking back on this in a year and saying, okay, well, what are the things that we talked about and what's been implemented? We're looking forward to continuing to find ways to work with you all at Vinyl. And to help move the markets forward. So thank you for the time today. And we'll look forward to having you here for round 2 at some point in the future.
Thank you, Rob. I think this has been a great opportunity. I've had a lot of fun today, so would love a second chance at so many things that we didn't cover today.
Yeah, fantastic. All right, everybody. That's it for us here at On the Record. Thank you for joining us.
We thank you for joining us on this webinar, and we hope you enjoyed this conversation with Brian and Rob. For more information, please scan their QR codes or visit us at vinylequity.com. Please stay tuned for our upcoming webinars. Join us on October 20th for a conversation with David Danovich, partner and corporate lawyer at Sullivan and Worcester,
where we discuss the difference between North American exchanges and the pros and cons when selecting the best exchange for your company.
Follow us on our LinkedIn page for any updates on the past and upcoming webinars. We look forward to seeing you on October 20th. Thank you again, and have a good rest of your day.